Hello everyone, it's Anton here from AyBe Invest. So in the last video we've talked about fundamental analysis. Now you know what it is, and we might as well implement it in the real world in our investing strategies, right? So I promised in the last video that we're gonna cover defensive investor strategy. So what it is, this is a quantitative long-term investment strategy first introduced by Benjamin Graham in his book, The Intelligent Investor. So this book was first published in 1949, which is quite a long time ago. However, this book was edited a couple of times, and the last edition, I believe, came out in the early 2000s. So even though it's an old book, objectively, it has so much wisdom in it, it is insane. And the main practices and visions hold till this day. It's amusing when you read the book and you just see the things that he describes are still holding till this day. So who might use this defensive investor strategy? First, if you want to outperform the broad market, if you want to outperform the indexes, you would like to use this strategy. However, second, you would also need to spend much more time researching the markets. So there are some specific set of rules in Graham's strategy, and you'll need to spend some time before investing. So if you're interested in spending much more time with the markets, if you like the markets and you like analyzing companies, and you would also like to gain much more than average in the long run, so please stay here and enjoy the video. This one is for you. Let's go. Alright, so a defensive investor strategy by Graham. There are specific, strict rules that an investor should follow in order to pick companies for his investment. So let's just go step by step through all the rules that Graham introduced. However, we would also need to adapt some of these rules because market conditions changed and these rules need to keep up with the time. So, rule number 1, the company you're investing to should be of an adequate size and have a stable financial position. We should consider every company from S&P 500 index as a proper candidate matching these rules, because to be included in S&P 500 you need to match some certain requirements already. All companies from S&P 500 are big enough and financially stable enough to be in that index. So I consider rules that Graham introduced in terms of size and financial stability too restrictive, and they would just take away good opportunities rather than limit bad companies from our choice. Any company from S&P 500 can be considered for a defensive investor strategy. Second rule, earnings stability. So Graham suggested that a company should have positive net earnings in some of the last 10 years. And we implement this rule here as well. Rule number 3, dividend stability. Graham suggested that a company you're as a defensive investor investing to should have uninterrupted 20 years of dividend payments. And in our days, dividends are much less important to an investor due to shares buybacks and reinvestment into the securities. So for this strategy, we will only require 5 years of uninterrupted dividend payments. Rule number 4, earnings growth. A company should see a minimum increase of 33% of earnings in the last 10 years, taking 3-year averages at the beginning and at the end. So we're taking this rule as granted as per Graham. Rule number 5, moderate price per earnings ratio, which is PE. So for new investors, you may not know what is PE ratio. So a PE ratio is calculated as follows: price of share divided by earnings per share. And PE ratio always changes because price of stock changes and earnings per share change. So PE ratios are changed quarter to quarter. You can easily calculate PE ratio from financial statements of the company. However, you don't even need to do that. Let me show you this great resource, which is macrotrends.net. So let's say you're analyzing an Intel Core company and you're considering it for a defensive investor strategy investment. So what you do, just search Intel Core. So you open this beautiful page, and to see companies' historical PE ratio, you just go to price ratios. Right here, first tab, PE ratio. So you scroll down, you close all the adverts, of course, and right here you can see PE ratio for every quarter. See, it's very convenient. For each year, for every quarter, you can see PE ratio. You don't even have to calculate anything by yourself. Just go to this resource and you'll see everything that is required. So now that you know what's PE ratio and where to get this info, let's talk about the actual Graham requirement for PE ratio. So he suggested that current stock price should not exceed 15 times the average of last 3 years EPS, or earnings per share. However, currently, due to much lower interest rates, we can move this requirement to 20. So what does this mean? The company you're analyzing should have current PE equal or less than 20, and this should be calculated as current stock price divided by last 3-year average of company's EPS. So again, to get EPS, it's very easy. Macrotrends.com, let's see, Intel Core, revenue and profit, EPS, here it is, annual EPS. See, you just calculate average of last 3 years EPS and you divide current stock price by this 3-year average and you get roughly 9.6 for Intel Core company, which is very good. So what this tells us is company is undervalued in terms of PE ratio. So for this requirement number 5, for example, Intel Core fits perfectly. And last but not least, rule number 6 is that company's PE ratio multiplied by PB ratio should be below 30. Again, PB ratio can be taken from company's financial statements. It can be calculated by yourself. It's much more complicated to calculate, however, than PE ratio. But again, you can just turn to macrotrends.com and it has all relevant historical ratios. You just come right here, price per book ratio, and you can see PB, which is price to book ratio. So let's see, current Intel Core's price to book ratio is 2.2, and we know that PE ratio is 9.6. So PE multiplied by PB for Intel Core is again lower than 30, which is great. It fits into this requirement. So let's just quickly recap. You take any company from S&P 500 because they're stable financially enough and they're big enough. Then you check whether they had any positive net earnings in last 10 years. Then you go and check if they've paid dividends in the last 5 years uninterruptedly. Then you go and check earnings that should increase by at least 33% in the last 10 years, taking first 3 years and last 3 years averages. And then you go to macro trends and you just check current PE. You calculate current PE in relation to last 3 years average of EPS, and last step, you multiply current PE by current PB and make sure that it's less than 30. These are all the requirements adapted to our 2021 year of Graham's defensive investor strategy. So, implementing all these requirements to S&P 500, at any given time, there are from 40 to 150 different companies that fit into all these requirements. All you need to do now is find these companies and decide your allocation. Of course, it's not recommended to invest all your money in just one company. You would need to diversify. But I found that a portfolio of 15 stocks that match defensive investor strategy requirements works great for me. There are some studies that have backtested this strategy of Benjamin Graham, and all the studies confirm that the strategy is working and it is outperforming S&P 500 index. And this is Defensive Investor Strategy by Benjamin Graham. So what you need to take away from this is that, first of all, this is a long-term investing strategy. So please do not expect your portfolio to go parabolic. This is not some single growth stock that gains 100% today and then loses 50% tomorrow. This is a value investing strategy. So you're buying undervalued companies that are supposed to grow steadily in the next 5-10 years. So with this strategy, you pick your companies, you create your portfolio, and then you revise once a year whether all your holdings still fit in the strategy requirements. The best way to follow this strategy is dollar cost averaging, which is invest in it regularly, once a month, once per 2 months. But the main thing is it doesn't matter what the stock price is. As long as it fits into the requirements that you outlined, you just add to your holding and add and add. This is what dollar cost averaging is. Doesn't matter if it's up, you add. Doesn't matter if it's down, which is better, you add. And you're looking for a long-term profits. Please, I beg, do not be bothered by this crazy Twitter posts about 100 and 200% gain in a day. This is speculation. These people gain this money and then they lose them even faster. Please be intelligent and invest into the future. Invest into value and be mindful of risks that investing carries with itself. So please let me know what you think of this strategy. Let me know what else would you like to see on this channel. So thank you for watching. See you guys in the next one. Bye bye.